Okie dokie. What is up, investors? Just checking out some news about French lockdowns. It's not looking too good all over the world in terms of coronavirus spreading. Of course, this was expected by anybody who understood the dynamics of COVID-19 spread. Um, Namely, as sunlight fades going into winter, and as warm weather fades, that coronavirus is um, more more widely extant. It survives longer out in the world, um, and thus it's likely to spread. More likely to spread than in the summer when there's, say, sunshine and heat. So the northern hemisphere looks like it's going to be a really rough winter. Now, if you want to have a global view of things, then on the other side of that, in the southern hemisphere, it's going to be summertime, and there should be abundant sunshine, abundant heat, and we can maybe um, look for South American markets to outperform. Maybe Australia could have a good little run of things. In fact, Australia might be a great play because Chinese growth is strong. China has returned to trend growth. Um, we have rising inflation, I believe, also in China. So, um, you know, Australia is highly exposed to the commodity sector and highly exposed to China as a demand source. So, yeah, those are some kind of interesting plays right now, I'd say. Um, Brazil and Australia. Anyways, the COVID-19 stuff is relevant because this stream is my first attempt to record something long about a very important fundamental factor in the economy and thus in the markets, and that is inflation. Um, Inflation is defined all different types of ways, but the traditional definition is an expansion of the money supply. Um, Expansion of the money supply can mean several things. There are, call it, four different, central bank measures that you would think about. Um, that's base money, which they call L0. Then there's L1, L2, and L3. Level 1, Level 2, Level 3. And these include various things such as checking deposits, savings deposits, bank reserves, and the second factor in this traditional sense of inflation is something called money velocity, right? Which is the rate at which money changes hands in the economy. Okay, before some point. So it could either be, the velocity in a month, the velocity in a year, or you could even take it to the extreme and think about how many times does a dollar trade hands before it vanishes, is extinguished. And you could say that money disappears when it's used to pay off debt. Okay, so the other way of thinking about the money supply, which is not exactly how central banks define it, is debt expansion. Okay, if, say, I go out and get a loan for a car, okay, well, I'm putting, say, $5,000 down. Okay, So that money is changing hands, right? I'm giving it to the lender. This money is still existent, okay? But now we in this transaction have just created a $25,000 asset, okay, on the balance sheet of the lender. So this $25,000 has now been created, okay? It's brand new money. And this is really the money that's floating around the economy, okay? This whole thing about central banks printing money is a little bit simplistic. It's not a true measure of what's going on. And I'm sorry, I just realized that I am streaming on the wrong view, so on the wrong scene. Let's pull this up, and this is not zoomed in the right way. Maybe I can. Wow. Focus is rough. Word. Focus is still rough. Getting the hang of this. One day. One day it'll work. Anyways, I wanted to do this stream to practice communicating these monologues or lectures or something. The reason why this is important right now is because we are dealing with a very, let's see what this stream looks like. So we are dealing with a particularly deflationary situation, okay? So inflation, right, is where the money supply is increasing, and as there's more money, assets become more expensive, right? Because say my house is not there's no productive value coming out of my house, right? My house doesn't go and build a business. My house doesn't go and get me paid, right? There's no additional money coming out of this house. The reason why the house goes up in value is because the money supply is increasing, okay? The value of the dollar is going down. As there are more dollars, but the same assets, the value of the dollar goes down against those assets, right? It takes more dollars to get the same asset. Right. So what you want as somebody who holds assets is inflation to go up slightly and steadily, okay? You want the price level to go up slowly and steadily. And this means you want inflation to stay stable, okay? Say you want your house to go up 3% a year, 4% a year, whatever you'd like. Okay. The problem comes when there is a shock to the economy, okay? And the amount of money stops growing, right? Because remember, we already established you want there to be more and more money so that your house is worth more and more of those dollars, okay? Say my house was worth 1% of all the money in the world, then, 20 years ago, it may have been worth, $1 million. And now as 20 years have gone by and there's 100 times as much money, okay, maybe now my house is worth $100 million. Okay, that's what you want. And as inflation stays constant for several years, what happens is inflation expectations, okay, become a tighter and tighter band around this 1% level. Okay, and And what this does is it stabilizes the growth rate of your assets. And so when the growth rate of the money supply and your assets destabilizes, okay, when the growth rate destabilizes, you can have a wild swing in the price, right? Because basically this destabilization was completely unaccounted for by the market. That's what happened with COVID-19, right? Super unexpected event that had global ramifications, particularly people weren't able to take out more debt, okay? And if you can't take out more debt to pay off your existing debt, then you have to use your cash to pay off your existing debt, okay? You have to reduce your leverage. And this is what people did. But the act of paying off that debt is actually not what caused the massive swing in the asset markets. Asset markets move based on expectation, okay? So once it became clear that this shock was going to happen, that's when the market moved, okay? Why is this important right now? Well, we go back to France. Switch my scene here. Boom. Anguish, fear and anguish in hospitals. The French cabinet is meeting. Okay. Surging all over Europe. Wow. It's amazing. A month and a half ago, France had 7,000 new cases. Okay, and this was a record. I'm not sure it was a record, but 7,000 cases was worrisome 6 weeks ago. And now, holy crap. First off, look at Germany, right? This is the seat of, the most powerful country in the EU. Just completely spiking out of trend on cases. France, boom. You thought 7,000 was bad? Try 70,000. Okay, so we're seeing a massive deflationary event taking place soon in France. Okay, Spain is not much better. Okay, huge spikes in Spain. So we do see Argentina and Colombia they're actually entering their summer months, right? So you could maybe expect these numbers to start dropping off. Or at least the growth rate not to spike. Kind of like how in the United States, during summer, the growth rate was stable. Not spiking. But you see now, as we're entering into the winter months, the United States has returned to linear growth with some exponential spurts, and it's concerning. It's concerning. As soon as the U.S. doubles these case numbers in a day, let's say, we spike to say 150. There's going to be widespread talks of lockdowns again, and this is going to cause very significant disinflationary expectation, which should roil the markets. Okay, so yeah, here's my little outline for what I was going to go over in this little video today. And we already touched on the money supply. We already touched on, inflationary and disinflationary pressures today. And the final thing, just to wrap things up, is to kind of look past this coronavirus thing. You know, one day the economy is going to return to normal. People are going to be out and about, spending money, traveling, staying in hotels, eating in restaurants, and taking out debt to finance consumption. So, um, basically, one day inflation is going to return to a normal trend. Say 1% a year, 2% a year. That's what you'd think. Um, all we know is the economy will go back to normal. Now, it could actually overshoot. Um, and what I mean by that is the government itself, say the US federal government, which would be the biggest actor in this situation, can actually cause inflation itself, right? Because the who is the biggest, um, you know, um, who is the biggest borrower in the world, you might ask? And it's the US federal government. Um, the US federal government takes out about 4 to 5 trillion, about $4 trillion in debt every year. And they actually don't pay, um, usually those bonds don't come due. Um, basically, that they're well, they do have bonds coming due, but they have 10-year treasury bonds, treasury bills, um, and I'm sorry, those are notes, 10-year treasury notes, and 30-year treasury bonds, which are coming due all the time. But 10 years ago, okay, the government took out, um, say, $1 trillion or $2 trillion, okay, as the debt. And 30 years ago, I mean, man, they took out, say, a few hundred billion, 300 billion, something like that. So basically, when the government is borrowing 4 trillion these days, I mean, it's nothing to pay that off. So what this means is that the government is um is the highest contributor to inflation. Okay, the government is essentially the main driver, at least the biggest fish in the pond, um, for the supply of dollars. So that is just to establish the government is a massive actor in this money market. Um, so the way inflation could overshoot, get past 2%, 1%, 2%, like we've had for many years now, is they could go and borrow big money, say 10 trillion, okay, double the budget, and then pump that into the economy. Okay, pump that into, say, um, new highways, new, um, say, highways, bridges, monuments, massive government infrastructure, utilities, clean energy investments, all kinds of projects that they could undertake. And it's important that they go and pump it into basically businesses that are going to pay workers and pay materials companies that are then going to go and pay those workers. Okay, because those workers are then going to get a lot more money and are going to then buy cars, buy houses, take credit cards, and the cycle continues and continues. And you want the money to be jumping around like that, right? Jumping around because um, the more the money changes hands, the more so the more that cash balances move around, the more debt can expand, right? Because if I'm getting cash flow, okay, then if I have that $2,000, I can go and take a $2,000 loan. The bank will give that to me because they know that I can get that $2,000, right? So as cash balances move around in the economy, debt has the potential to expand, and this expands the price level. So yeah, over the long term, say, especially if we get this democratic government in the United States, expect inflation to pick up materially over the last, from the level that it was at over the last 10 years. All right, y'all. Well, let's just look at the markets really fast, and I'll sign off. Been on here long enough. I have to check out the audio quality. I know the video quality was quite spotty, but I find this very fun. So we'll keep doing it every day. Let's check the NASDAQ. Not too poor. Writing support. Over here, it kind of looks like there's some serious margin for a decline. 5-6% from here to support, say, over the next week or two. But generally, you'd probably expect the if the bull market's going to continue, then you expect this support to hold. But who knows? If we get a fall, this blue moving average should cross the red. We could come to, we can come to the bottom here to this next support, and then say chop around in here for a little bit. This may be likely to chop around, considering these deflationary pressures, right? I mean, I guess I'd expect the market to prefer to remain in here rather than above support. Okay, that's the NASDAQ. Let's check oil. Oil's a mess, clearly. Very choppy, just sideways. This is resistance. Let's look at the Dow 30. This is bad. This looks quite. This is now a valid breakdown, which looks bad. Yeah, highly valid. So let's just look a little bit further out here. And yeah, it doesn't really look good for the Dow. Especially with these deflationary pressures, I would certainly expect this to happen. Something like that, eventually. This can pop up. This can pop up like this, but if Biden wins, man, look out. It's gonna be tough for this stock market. because of the taxes that are going to come out. People are going to want to take gains, I think. Not in Vice. But alright, people. Those are the markets for now. Let's check the French stock market real fast. And whew, that's not good. Solid day, down 2%. Solid day for the Bears. Solid week for the Bears, down 5%. Just kind of coming into support. But anyway, there's nothing stopping this from churning down into here. It's possible. Alright, people. Well, thanks if you stopped by. Hope you learned something. Try to make this better in the future. Peace.